Dhananjay Sinha also joins us on the show right now. Dhananjay, are you convinced by the argument towards staples and, these FMCG companies? Should one start buying the defensives?
So I think the commentary from the FMCG companies, I think we saw the results from HUL yesterday, and also the commentary, management commentary. The stress as far as the demand scenario is concerned is continuing. I think the demand scenario remains lackluster. I think the guidance they're talking about is that it would still take about a couple of quarters to get a sort of a reasonable recovery. But I think what is important, if you look at you know what they are trying to do is to really look at their strategy with respect to premiumization and all. So they're trying to look at this whole D2C business that they have acquired, how they can actually ramp that up and all. So basically, the attempts would be more towards. I would say for most of the consumer companies to ramp up realization through better product mix and all. Overall, I would say that the demand scenario for the rural, which was supposed to do better, I would say, based on some of the indicators the market was looking at, has not really panned out as robustly as it was hoped. So I think that is a drag as far as the ongoing season is concerned in the consumer space. I think the hopes are that in the upcoming budget there will be a certain amount of allocation in the rural space. There will be more spending on revenue side, which can enhance the sort of consumer spending power. Possibly they are expecting some tax move as well on the direct tax, but indirect taxes is something that would be more helpful, but that's outside of the budget. So I think the market is kind of trying to build in a hope trade or a hope situation where the disposable income spending power for the household improves. So I would say some of these companies are good companies. They have corrected a lot in terms of valuations. I think if you look at 12 months down the line, I think they should improve as far as business traction is concerned. I think we'll need to really look at what their product strategy and pricing strategy are. But with the kind of correction that has happened, it is possible that this year they can actually give a reasonable return. With the context that the market might actually remain mostly flat, I would say, because on an average, we're looking at earnings growth, which might continue to see downgradation, and possibly we end up in a with an average growth of about 4 to 5% over the next couple of years. So I think we'll need to really look at where the attractions are. In that context, I would say with the correction that has happened in the consumer space, there might be some performance that can be seen.
Okay, interesting. Dhananjay, so far from the earnings, largely it's been the IT pack which has come about. What's been your takeaway? Where is it that you're seeing both growth visibility as well as some amount of valuation comfort after the recent correction?
So I would say that our view has been that the IT space has been an overweight area for us. And if you look at the results, I think the December quarter did not show so much of excitement because this was a lean quarter and you had an election and all, so that reinforced the leaner. So the lean quarter was leaner than expected. So I would say that going forward, you might actually see some traction going up, traction might actually be visible. And some of the indicators that we are looking at is the increase in the margins, possibly the revenue mix is favorable. We have currency correction, currency depreciation has been there, that's contributing to the margins. And also, if you look at the hiring cycle, if you look at the attrition ratio, how it has moved, and incremental hiring that IT companies have been making, I would say that it is actually bottoming out after a sort of a correction in the past 1.5 years. So there does seem to be some stability, and I think the commentary from the companies are also that there can be some improvement, especially in the US markets. There's been some traction as far as the BFSI space is concerned. There are certain segments which are still seeing some amount of stress, such as media and other such segments. But I think a bulk of it is basically your BFSI, healthcare, etc. there is some positive traction that's there. So I would say that that's where we can see earnings support coming up. But by and large, if you look at the other segments such as the banking sector and all, I think there will be that segment will actually see correction. We are seeing margin pressure that's been there, and we will see credit cost also ramping up. We are seeing that in the banking sector and the BFSI sector in general. So that's about 33% of the weight in the Nifty. I would say the consumer space can do better if there is a commodity price correction. I think HUL talked about the input costs and stuff. So I think if there is a correction in the commodity prices, there can be improvement. But I mean that will be a function of how things pan out during the year. Likewise, I would say in the auto space, while the volume growth for passenger vehicles and I would say even trucks, commercial vehicles been contracting, I would say there is some resilience in tractor and the two-wheeler segment. If the steel prices come off because of the pressure in China and the dumping that is happening there, I would say that there can be some expansion there as well. I would say what I'm circumspect about is the infra spending that the government's been doing in the industrial sector that is dependent on that. So I think those are the broad thoughts I have at this juncture.
Still weak, 117 points lower is where we're currently at. FMCG clearly seems to be that one hiding pocket from those oversold zones, partly quiet. And today, technology is unable to really hold on to its gains. So, Infi Wipro, yes, in the green, but less than 1% or so, and flat for TCS as we speak right now. Dr. Reddy's, of course, has taken it on the chin after its numbers. That stock still lower by about 6%. Trend is seeing more selling. It's down 4% as we speak right now. I think it's broken that 5,500 level as well, which was a key support. M&M down 3% right now on the stock. Tata Motors, IndusInd Bank, BEL, L&T, the selling has not been awaiting. But Kunal, sectorally, what's looking like the weakest pocket right now within large caps?
So banks is of course the weakest pocket, and within banks also I think it's more the private sector banks, which I think is been a big underperformer. Of course, the PSU banking lot, even the large cap names like Bank of Baroda, PNB, SB, etc. Even these stocks have been underperformers. But then financials and banks specifically have been a key lag or a reason why the markets have dragged down significantly. And then when we were looking at the the distribution over the last few weeks, it was the metal stocks which were leading the charge on the downside. Then you have real estate stocks which have been going through a sharper correction. Many of the real estate stocks have gone through a multi-week, multi-month, or have formed a multi-week, multi-month low for themselves, the likes of DLF, Prestige, etc. So I think it's now trickling into the the high beta pockets of the markets where you're seeing an accelerated kind of a sell-off.
Accelerated it is. But Dhananjay, what according to you explains this weakness in the private banking names? You think it's just the FI sell-off, or is there more to it, reading into the numbers of an Axis, HDFC Bank, Kotak, and now we've got ICICI Bank over the weekend too?
So I think generally, if you look at the banking sector, it's very difficult for them to really grow in the context that you have a peak level of credit deposit ratio. Many of these private banks are at above 90% credit deposit ratio, and it's very difficult, for them to really ramp up their deposit franchise, especially in the context that the rupee has actually depreciated, and that has actually tightened the systemic liquidity, and that essentially means that the money market rates have remained high. I think that sort of adds up to the margin pressure and the cost of fund that would entail in the context of the monetary conditions that are there. I think the hope that the market had was of rate cuts by the RBI sooner than later. I think that's getting postponed in the context of rupee depreciation. So I think that is this whole growth context and also the margin context is actually weighing on the banking sector. I would say the other thing is, of course, that we are gradually seeing the pervasiveness of the credit cost emerging from the retail lending that had been fairly exuberant in the past. I think that's sort of coming home to roost. So I think that's also weighing on the fundamentals of the banking sector. I would say PSU banks had done phenomenally well earlier on, but I think there has been a considerable derating also that has happened in the PSU banks. I think the price to book for PSU bank index was 1.8 times. I would say 8 months back. Today it is 1.1. So there's a derating that has been happening, and I think it could continue. So overall, I would say, where we think that the banking sector can actually do relatively better is banks who have better ALM, who have low credit deposit ratio. So I think there are multiple filters that need to really look at when you look at the banking sector investment. So I think I would say if you look at the cycle, I would say it would still be about 1.5 years out before equilibrium is actually put in place convincingly, as we see today. So I think the banking sector will continue to see a drag as far as valuations and the business cycle is concerned.
Financials will continue to be a bit of a drag. That's the word coming in, Dhananjay. On that note, we let you go. Appreciate you making time for us today. But the big talking point, of course, has been the FI outflow that we have seen from India. In fact, over the last 4 months, we have seen outflows to the tune of almost 2.5 lakh crore. And the FI ownership in the market is now at a 10-year low at just around that 16% mark. But that was led by the dollar strength and the attractiveness of the US market. Dollar has come off quite substantially. And I say substantially because from 110, 111 levels, it's now down to 107. And gold is the one which is spiking. Kunal, you track both dollar index as well as gold quite closely. Tell me what the way forward is, because gold, believe it or not, is 80,000 rupees in India.
Yeah, and I think we were discussing this some time back that gold, I believe, is starting to look very attractive. In my sense, that gold prices now should start to move up higher. I was earlier looking at a consolidation for gold prices some time back, and I think from 80,000 levels, we moved towards 72, 73 odd, 73, 74 odd in terms of rupee. Now I think what we are seeing as a distinct price behavior is dollar index has started to take resistance at the 110 mark. I think we've tried to break past about 110 levels twice in this last 1 week of price rally for dollar index, but we've unable to surpass those levels. And on the downside, I think we went to almost 107, 107.8 on the dollar index a couple of days back. So which means we are trying to establish a $3 range for the dollar index from 107 to 110 odd mark, and we could probably fluctuate in that kind of a band. Gold, on the other hand, I think looks very attractive, and I think both in terms of rupee as well as in terms of dollar denominated gold prices, I think we've confirmed a strong breakout on the swing basis for this asset class.
Right. So Kunal, let's have some closing ideas from you, and then of course your BTST trades as well.
So I'll go with one buy and one sell at current levels. The first one is a buy on Titan. That's a chart which is looking attractive in terms of BTST. Targets of 3,500, stop loss at 3,340. And the second would be a sell on Havells. That's a stock which is confirming a weakness on the charts and on the verge of breaking previous swing lows. 1,500 is a target, stop loss at 1,560. In terms of closing trade, Indian Hotels is something which we discussed a few days back. That's a stock which has been taking support at 750 odd mark. So looks attractive for a buy.
Okay, and what about your closing trade idea? I mean, okay, you've given both closing trade as well as BTST. So Naresh, what about your closing trade idea for now?
So that would be a buy on Britannia, a defensive bet here. The stock has given a short-term range breakout. So out there expecting a bounce back towards 50 and 50, 5,200. Stop loss to be kept at 5,070.
Another fall, and the Nifty Bank has fallen a good 1.25% from the top of the day.